Hey everyone, this is Scott Miller at Cool Trading Tools, and I'd like to talk to you today about margin and leverage. So, why do we need margin? This is something that is not really well understood. So let's say we've got $1,000 to invest. We're looking to make some money. We take a look at this euro-dollar daily chart and we see it looks like things are trending up and prices come down close to our trend line and looks like it's bouncing up off of that again. I also have the ATR on my chart, and the ATR tells us what the average candle size is over the last 14 days. And it's a way of kind of predicting how far price can move. So let's invest in the euro. Euro right now costs $1.13.5, and the average daily range of the price of the euro is kind of in the neighborhood of 0.67 cents. So we buy $1,000 worth of euros. The next day, the price goes up by that average daily range of 0.67 cents. We win our trade. So how much did we make? We take our 0.67 cents and divide that by the price that we paid of $1.13.5. We get 0.59%. So our 0.59% times $1,000 is $5.90. So we made 0.59% on that trade. And the question is, can we do any better than that? So the question originally was, why do we need margin? And the answer is, in order to get leverage. So what's leverage? Leverage is a tool that's provided by a broker, allowing a trader, that's you, to control more money using just a deposit as collateral. So leverage is expressed as a ratio, like 50 to 1 or 100 to 1 or 1,000 to 1 or 2,000 to 1. This means that if you have a leverage of 50 to 1, for every $50 you trade, you provide a deposit of only $1. So you're controlling $50 with $1. And that deposit is called margin. Margin is often expressed as a percentage. So a leverage of 50 to 1, the margin is the inverse of that, or 1 divided by 50, or 2%. So our margin is 2% of the amount that we want to trade. So let's have a look at that. We still have $1,000 to invest. Everything is the same, but now we have an account leverage of 50. We still want to risk $1,000 buying euros, so we buy 1,000 times our leverage of 50, or $50,000 worth of euros. The next day, the price goes up by 1 ATR, and we win our trade. So how much do we make? It's still 0.59% increase in the price, only that 0.59% is multiplied by $50,000 instead of $1,000. So we made $295 with an actual return then of 29.5%. That's a much better return, but it's not smart. Why is that? So first, let's define some terms. Balance is the cash in your trading account. When you open up an account, you put some money into it. That is your balance. Equity is that account balance offset by profit or loss of open trades, and we'll be illustrating that here in a little bit. So you deposit $1,000 into your account. So our balance is $1,000. There are no trades on, so our equity is $1,000. Now we open up a trade, and if the trade doesn't move, we still have a balance of $1,000 and equity of $1,000. The trade gains $100. Now our balance is still $1,000 because it's the amount that we put into our account initially And we have an open trade now, so our equity is now at $1,100. The trade then loses $200, meaning we've drawn down from our original $1,000 by $100. So our balance is still $1,000 and our equity is $900. You close the trade and now our balance reduces to $900 and our equity is at $900. So your margin now is a portion of your equity set aside by the broker to open trades. So in this case, we've got $100 of margin that's set aside from your equity, and we have $100 of profit. So our equity is at $1,100, our balance is at $1,000, and our margin is at $100. As you add trades, your margin goes up. And as you lose money on trades, your equity reduces. But when equity equals your margin, that's the margin call. Now, every broker sets their own level for where a margin call happens, and so you'll have to check with your broker to find out what that level is. Your margin level is shown as a percentage, which is calculated as your equity times 100 divided by the number or by the amount of margin used in dollars or in whatever your account currency is. A margin call is a broker's notification to you that you're in trouble. You'll need to add cash to your account or close trades. The margin stop out is what you're trying to avoid, and that is where the broker closes positions for you. And using Murphy's Law, you can assume that the broker is going to close the trades that you least want to close in order to get you out of margin difficulty. So this is something that you definitely want to control yourself. So in order to find out where your margin call level is, we can go into the Market Watch, choose the symbol that we're interested in, right-click on that symbol, and then select Specification. That will open up this window. There's some interesting information in there. The margin percentage that's shown is your margin call level. So this is 100%. That means that when your margin percentage is up to 100% of your equity, you are in a margin call and you need to close trades. The margin stop out level is not shown in a way that you can get hold of here. You can find out from your broker, or Cool Trading Tools has some tools that can help you find out. Contract size is your base units in one lot. So if you're trading euro dollar, your base units is the euro. So that means that if you're opening up one lot, it's 100,000 euros. The lot size on your trade is multiplied by your contract size. So if you have a lot size of 0.01 and you are opening up a trade, that's going to be 0.01 times your 100,000 or $1,000 in euros. So let's go back to that $1,000 investment. Everything here is the same. We have our 1,000 times 50 to 1 leverage, or $50,000 worth of euros. This is exactly the same as the last illustration. So our equity is at 1,000. Our margin use is at 1,000. So we're at a margin call level right now. If the trade moves in our direction, we get out of margin call difficulty and we maximize our profits. But if the trade moves against us, bang, margin call and a broker stop out. This is why maxing out your leverage is not smart. We need to manage that leverage. So how can we avoid these margin calls? Remember that the margin call is a drawdown meeting the used margin. So our used margin is growing from the bottom in this illustration, and our drawdown is coming down from the top. Therefore, there are two main avenues available to us. We can limit the margin use, that is, control it from the bottom side. How can we do that? We can use smart, consistent lot sizing. And that is the means of setting up your lot size so that your margin use is kind of under control. You can set a minimum margin percentage. That would be a question of if your margin call level is at 100%, then you can set a rule for yourself that says if we get below 500%, we're not going to take any more trades. So leaving yourself buffer. And you can use more leverage. So using a higher level leverage broker, and you can go pretty darn high. 500 to 1 is not uncommon. 1,000 to 1, 2,000 to 1 is available in some unregulated brokers. So using more leverage will reduce the amount of margin that's applied. And you can limit the number of trades. So you don't open up too much. If you start approaching whatever your rule is for your margin percentage, you don't open any more trades. You can also limit drawdown. That would be controlling it from the top. And again, we can limit the number of trades. So the more trades you've got on, the more possibility of loss you have. You can use smart, consistent lot sizing. That would be controlling how much risk you're putting on a given trade. And you can set maximum drawdown per entry, which is also part of your limiting drawdown. Set your max drawdown per entry using a stop loss or using hedging. Be careful with hedging because hedging will increase your margin use because you're opening up another trade to trade in the opposite direction that uses additional margin. But that's mitigated if you're using a high leverage broker. And avoid positive correlations. Now, positive correlations, we'll be discussing that in some detail later on, but that would be anything that if you've got 2 trades open or 4 trades open and they all tend to move together. So if one goes down, they all go down, that's going to be increasing the amount of drawdown that you might have. Now, if you have limited number of trades and smart, consistent lot sizing and maximum drawdown per entry, it's less of an issue than it might be otherwise. So this brings us to some principles in margin management. Have rules for appropriate trade size. Your size should allow your trade to move against you. Your size should relate to either the target or the stop. Your trade size should be related to availability of equity. And your size should account for your leverage. Also incorporate factors of portfolio diversification. Trading multiple symbols long or short one particular currency will mean outsized exposure. This is a correlation. Trading multiple correlated instruments in the same direction means outsized exposure. That could be something like U.S. oil is correlated often with the Canadian dollar. Reducing correlation in portfolio can help reduce excess pressure on margin use. Also have rules for maximum margin use. This would be our minimum margin percentage that we discussed earlier. The level should allow for trades to move against you. You must consider your account leverage and consider your trade plan's rules for number of open positions. Also, you should have a money management plan. One size never fits all in this particular case. You have to understand your plan and its goal. Your plan might maximize gains at the expense of increased risk, or your plan might minimize risk at the expense of decreased gains, or you could be looking for a sweet spot someplace in the middle. Your plan can incorporate more than one account and its leverage. For instance, you could be trading one account with low risk for the bulk of your investment capital, and you could be trading another small account at high risk with the intent of trying to do fast growth and then take that growth and put it into your larger, safer account. And your plan can utilize multiple styles of trades and investments. You can be trading in different instruments. You could be trading stock markets, you could be trading Forex, you could be trading cryptos, you could be in real estate, you could be in all kinds of different ways of making money. But that could be all part of your money management plan. And don't forget that your plan can also incorporate cash holdings. So let's say you opened a brokerage account and you've got $100,000 available to trade. You can have just $10,000 or even just $1,000 of your available cash, your account that you're trading, and leave the rest as a buffer. So if you are trading high risk, let's say you're risking 20% per trade in your small $1,000 account with $100,000 of capital, that 20% is actually only 0.2% of your available trading capital. That allows you to trade high risk in a way that really isn't high risk. So, how can cool trading tools help you with margin and leverage questions? We have two primary tools for getting to this. The first is the Swiss Army knife. If we hit the I to pull up the information table here, we can see that our margin per standard lot is $132 on this particular account. On Forex pairs, Hugo's Way offers 500 to 1 leverage. So this is representing 500 to 1 requirements. If we were on a lower leverage broker, that would be reflected. If it were, say, 50 to 1, then it would be $1,320 for one lot, and so forth, depending on the leverages being offered. Now, if we are trying to structure a trade, we can say we want to take a buy. This is using the B key on Swiss Army knife, and this brings up our little price tags here. This represents the stop loss, and this represents the take profit. So we can take this tag and drag it down somewhere below our recent swing low. And we can move this up if we want to. That's really unnecessary as far as finding out what our margin is. But notice this line here that says our margin percent after the trade would be 3,800 roughly percent. And that's using a lot size of 0.68 for this $3,300 demo account. And as we move our stop loss closer, our lot size increases and our margin percentage decreases. So watch this margin percent as I drag this down. Notice how we're using less and less margin as our lot size is decreasing. You pull this up really tight. Now we have 3.5 lots and we're down to, 800%. Now, what happens if we switch to something with higher margin requirements and larger size? We'll go to US 30, and here, if we do our information tab, you'll find out that our margin per lot is $16,084 per standard lot. And so even a 0.01 would be 1/100th of this, or $160.84, just to put on a 0.01 trade with this particular broker. If we put a trade on here, we're on a 5-minute time frame, and looks like we might still be moving down after this big move during the previous day. So if we say we're going to sell, we move up here, maybe up above this gap, and put our stop or take profit down there. Again, that doesn't really matter. So that's saying here that our lot size, we can't even put on a trade and keep our 2% risk profile here. So if we move this down closer, we're now at a 0.02, so we can get the calculation actually done, which tells us we're going to have about 1,000% margin percentage after the trade is put on. Now we can also do this if we do a pending sell. We can kind of find out what this would be by dragging these guys around. We can do it irrelevant to price and things won't be bouncing around. So notice here we're still below our minimum trade size. Notice that this doesn't change if we don't have a valid lot size calculated. If we get down closer to it, we can see here we're at 0.01. So there's our margin percentage. And we get this down tighter and tighter until we see that we can go into a margin warning, which brings us down below our margin threshold to put on a 0.07. So I have the margin threshold set to 500% right now. So this is how Swiss Army knife can help, by calculating where your margin would be after you put the trade on. The second margin-related tool we have available to us is the cool margin meter. That's this right down here. This is showing what the margin meter would look like if we are flat, meaning no trades on whatsoever, no margin used, no profit or loss. So if we had a $1,000 account and we put on a trade and we end up using, let's say, $100 in margin, this would jump up and tell us here that we're at 1,000% margin. And if we hover over here, we can see that we're using $100 of margin with this trade, and that's 10% of equity, and our margin percentage is 1,000%. Now, this blue bar here is indicating where our margin warning threshold is. So that is set to 500% by default, and you can put that wherever you want. If you're using a lower leverage broker, you might need to push that down a little bit in order to have effective trades. But then you have to be carefully monitoring your margin usage, and that's what this tool is for. So let's say now we bump ourselves up to $210 of margin usage. Notice that our margin usage turns orange, meaning that we have gone over our limit. If we go here, we can see we're using $210 of margin, which is 21% of equity, which brings our margin percentage down to 476%, which is just below our 500% equity. Now, let's say we have those on, and we also set up a pending trade, and our pending margin is another $100. So the margin required for our pending trade is $100. What happens then? We get this extra bar that comes over here, which is orange, also indicating that it is beyond our margin warning threshold. And this is telling us where our margin usage would be if that pending order gets opened up. Now, what happens if the trade starts winning or losing money? So let's say we've gained $200 and we get our equity up to $1,200. Now, notice what happens here. Our equity is showing in green. This is where the balance is, right here. And our equity is out here at $1,200. This is our $1,000 balance. And notice this has actually pushed our margin usage back below our threshold. Our pending margin is still beyond our threshold, meaning it's still orange, but our margin usage is now down. The margin percentage is back above our 500%, which is in the safe range. Now, what happens if we start losing money here? So if we drop down to $1,100, our equity drops. We're still very close here. Now, if we know that if we were at even, we're just slightly over threshold here. Now, if our balance continues to move down, let's say we are at $900 of equity, $100 loss, it starts showing here. Notice that this is a little bit wider now. It's sticking a little bit beyond because of our losses here. We're deeper in. And if we look at this, our margin percentage is now down to 429%. Now, the cool margin meter also knows about another thing. So let's say we go back up to, now we'll keep it right here. We're a $100 drawdown right here. We're at a 10% drawdown on balance. Now, we have stop losses in place. The cool margin meter can look at all of the trades with their stop losses and add up what the maximum loss on this account is if they all hit their stop loss. So if we have our max loss indicating that the most we're going to lose is $200, we get this block down here that shows that this is as far as it's going to go down. This is where we are now, right at this point, and this is how far we can go down. Now, if we start gaining equity again, let's move up to $1,100, or we're starting to move $100 into profit. We're still showing our max loss is still $200, but we have our equity moving back up here. Now, if we go up to, let's say, $1,300, or even further up, we still have our same 20% possible loss based on this. And we have a pretty large profit. But now we move some stop losses into profit. And what ends up happening there is that our max loss now, let's say the aggregated stop losses make it so that we're going to gain a minimum of $100. What starts showing here is that this is where our aggregated stop losses are. So if all of our trades hit our stop losses, this is the minimum amount that we are going to gain. So we're going to gain 10% on our account, even though we are up by 30% right now. Now remember, we have a pending trade on that can use some margin, but the other thing that can happen is that our pending trades also have a certain amount of loss possible if they hit their stop losses. Now those pending trades are on with their stop losses set, and so there will be a number associated that if they have a stop loss. And so let's add $100 of pending max loss to that. And that moves this little, see the little orange or rose-colored bar that moved from here, because there were no pending orders, down to here. That is the $100 of max loss. So it's the pending max loss comes from this point here, which is the most we can lose on our active trades, and that $100 is there. So if I take the pending max loss and make it $200 of max loss on the pendings, that moves it out here. So you can see that it's twice as far as this $100. And this gives you kind of an overall view of what's possible in your account and how this is all going to be protected. The cool margin meter can also show you all of your individual trades and their margin requirements. So let's set up a pending order on something here. You can see how this impacts. So we're at dollar CAD. We've made a big move up. Let's say we're going to expect that there be a retracement, and we want to look for a breakout below structure. So we'll set a pending sell, and we pull our open price down here. We want to set our stop loss up above the swing high, and we're looking for, let's say, a 50% retracement somewhere down into this range. And we'll move this guy down here. So this is setting our size to 0.68. Our stop order is set here, and our margin percentage after the trade is going to be 24-30%. And so let's go ahead. Let's see here, put auto trading on. And now we can sell pending. So here is our pending order. Notice that our cool margin meter now is showing that we have a pending order that's bringing our pending margin down to 24.30. And if we click any place inside of this, we can open up and see all of the orders that are in here. We're using $136 in margin. We have no profit. Our max loss on this is going to be $72.25, represented by this space right here. And so the type here is a sell stop. And we can have a sell stop, a buy stop, a sell limit, buy limit, or a buy or a sell. Those are our order types. And it tells us what pair we're on, because these can be on all kinds of different pairs. So we could put another one, let's say, on silver, and we're going to set up a pending sell, and I don't know, we'll put a limit order up here. This is just for illustration purposes, so we'll do another pending sell. Now notice that we increased our margin usage down here, and now we can see both of those. Go in and close the silver trades, and we can go back to our dollar CAD, and we can close those. So that is the cool margin meter and how it can help you with margin.